Good morning, everyone. This is part 2 of the Make Money Work For You session, where we're going to talk about real-world trading strategies and recap what we've already learned to reinforce knowledge. Just a quick risk disclaimer. Futures, stocks, and options do involve substantial risk. It's not suitable for everyone. This is risk that you take on, and I would highly suggest that you learn strategies first using a paper trading account so that you understand what you're doing before you take on risk with real capital. You can read the rest, and I'm just saying that I'm teaching you how, but you do need to understand this risk is for each investor. I'm the presenter. My name is Brandon Schumacher. I'm an advisor to the chapter, was the 2014 state president of JCI New York State. Helped found the chapter, and if you need to get a hold of me, that is my email address. Real quick agenda items. The first one is a basic profitability strategy recap, just so you can understand how to profit from trading. Second is basic chart reading and technical analysis recap. Third is going to income strategy number 2, which is options credit spread premiums on stock earnings, which is, whenever a stock has an earnings report, there is a potential to earn profit from that. And strategy number 3 is directional calls and puts on stock price movement. So basic profitability strategies, how you earn. So as time goes across the bottom from left to right, imagine a stock price that is going up. Obviously, when it's lower on the left hand and higher on the right hand, that means it's going up generally. That's the trend. Now, the key is to buy low at the lowest point that you can, and to turn around sell at the highest point that you can. This is a bullish sentiment. Inversely, again, time moving left to right. If the stock price is higher, say yesterday than it was today, you have a downward trend. Again, you could sell high and then turn around and buy back low. This is called shorting. This is a bearish sentiment. The third profitability factor that we're going to talk about, or the third way you can profit, is through options. Options have a thing called Theta, which is also known as time decay. And it is such that if you buy an option and price does not change, let's say it trades sideways, at 120 days out, it's worth, say, whatever full value, and then at 90 days out, it's going to be worth about 90%, and then at 60 days out, it's going to be worth about 80%, and then at 30 days out, it'll be worth about 67%, and then that last 30 days is a very steep decline. So with that, you could sell options and buy them back worthless. And assuming that the stock does not move against you into the sort of in the money direction that you sell it, you kept a profit when you sold it, and you don't have to give it back when you buy it back. You're buying it back for as cheap as possible, or you're letting it expire worthless. Real quick, I'm going to explain the difference between stocks and options. So stocks, which are on the left, and options here on the right. When it comes to leverage, meaning the amount of work that your money does, it's essentially, for, I guess, gain or loss anyway. So in the case of a stock that's, let's say, valued at $100, for instance. So you have one share of a $100 stock, and if it increases in price by, say, $1, you will have $101 and you will have gained $1 profit. Versus with options, you are controlling 100 shares of that same stock at $100. So if it increases by $1, your options contract will have gained $100 in profit. So now if you decide to get 100 shares, then yes, your the $1 move in the stock will gain you $100 profit, but you will be risking $10,000 in that case. With regard to expiration, stocks do not expire. That is one of the great things about them. However, that expiration in the case of options, yes, there is a nonlinear decay that accelerates over time. However, this decay you can use to your advantage if you choose to sell an option to someone else. Risk, quite simply, you're risking the entire value of the share, and in the case of 100 shares at an example share price of $100, you have $10,000 risk. Conversely, or in comparison, one call contract for a same $100 share is roughly $300 down to $8 risk, depending on how far out of the money it is. I will actually show you that example here. So here we are, we have JPM, which is an underlying of $101. Even if you choose one that is expiring not next week, for instance, like maybe it's the week after, whatever. So in this case, if it's next week, it's $200 down to $3. There's even a $1 here, versus the week after, you're looking at $297, which is roughly $300 down to $3. So much less risk involved with, or downside risk, I should say, involved with options. Whether they can be, or can they be bought with margin, which is lent or a loaned buying power from your broker. Stocks, yes. In rare cases, or in some cases, options can be bought on margin. In the case of an IRA, no, they do not loan margin for IRAs. Can they be traded during pre/post-market hours? For stocks, yes. Options, no. Down below are some links that have further explanations as to generally why options are considered better than stocks and are better for making short-term profits. And I suggest checking those out. Now, if you're the type of person who is essentially just trying to build your retirement fund for, say, 30 years down the road, stocks may be what you consider the sort of set it and forget it, least risky of all equity options or equity instruments, and for, say, an IRA. And that may be true, but I can tell you that you can do essentially 100 times the amount of profit with less risk using options. Why an option is, or how an option is different from a stock, I guess just trust me that it decays over time and it's much more profitable than a stock if used appropriately. There's three types of analysis that we talked about before, which is technical, fundamental, and sentimental. Sentimental is essentially like, what direction is the stock going? Big picture. And I'll say that, in 2020, we've actually seen two fairly significant crashes. One that happened in the last week, one that happened in late February. And that's unusual. There was some years that there was no crashes at all, or no drops, let's say. So, and a lot of it has to do with the virus. But it also has to do with, things like politics. So, you know, when looking at this chart here, which this is sort of the plain view and trading view, you know, you can see time across the bottom here and how the sort of this particular instrument, which is TQQQ or TQQQ, you know, for roughly 2 years had almost a constant increase, with the exception of these two little sort of quick rally and drops. And then you'll notice that the percent at which, or the the sort of rate of rise increased since I would say November of 2019, right? And you know, it means that obviously if you put money in down here and took it out up here, you would have made about $90 per share. But you would also, you know, there's not exactly enough information to be able to make decisions about when to put the money in or when not to. So real quick here, I'm going to pull up one more window here, and I'm going to trading view. I'm sorry. And so this here has a little bit more information, and I'm going to get into exactly how we get that. I'm just going to go to the blank view that we have here. So Tesla is a different stock, and I'm actually going to continue to use TQQQ. And as you can see here, we're on the 1 minute time frame. If we went back to the daily time frame, is where we can see that same view we had. And generally, it's not enough information for you to be able to make a trading decision. And that is that, you know, in the sort of microcosm, you want to know, like, when was this going, or, you know, let's say that it was dropping right here from September of 18 until December of 18. You want to know when to get in on this or when to get in on this. And the, you know, when it's falling, let's just say, you know, it's hard to make that decision because you to get in on a bullish move would essentially be going against the trend, right? And it's very hard to be going against the trend. It'd be like running into a burning building when everyone else is running out. So now there's indicators that I started to introduce you guys to before, and I'm just going to go build this back up so that we can, you know, understand this a little further. So under indicators here, what you want to do is have a basic understanding of volume first, because, you know, as you can see, when the price is falling, the volume is also higher, right? Like here, the volume elevated. And this is daily volume, by the way. And even here, the little red sticks at the bottom meant that the price was or meant that the volume was higher, even when the price was falling, which is lots of people unloading shares, not buying. So one thing that's also helpful is I tend to use a thing called MACD, MACD, which is moving average convergence divergence, which helps make decisions. And there's a couple different flavors of it. And I actually came across this one called Tories right here. which I found to be a little bit more useful than the average one. So you can see these little D's and H's down here. And those actually indicate a little bit more detail about what's going on here. So let's say that we zoom in on this time period here, right? So these three red dots are essentially at a point in which, and see this red line is actually crossing this blue line, which basically is indicating a bit of a drop, right? So if we were using the sort of thought of sell high, buy low, we would be selling, or in the case of an option, you would be buying a put, and then back at this point, which is not quite where this red line crosses here, is when it's going to start in change course. But, you know, this is on the daily, which the daily is like much bigger trends. You can also, I guess, begin to understand that even on the 1 minute chart, there are these moments which you can also think about, okay, I should buy here and sell here, which, you know, by the way, this is in September of like, you know, this year, where, you know, at this low with the D, which is actually right at the point where the blue and the red line cross, you could buy. And then now the key here is that you have this little red dot and this cross. The red dot actually happens before the cross, but as you can see, that's an inflection point where that rally stops and then it reverses direction. So that's just a little refresher on just kind of how to understand these candlestick charts. Now, I'm not going to get much more into detail regarding that because we're going to get to the two strategies that we talked about because I want to make sure that we go to those. And let's see here. So getting back over to income strategies. Oh, all right, hold on here. So just to remind everyone, this whole sort of concept of a limited time offer. The stock earnings reports happen 4 times a year for, say, Tesla, Google. Now TQQ is different, or TQQ is different because it's actually a ETF, so it does not have earnings. It's a compilation of lots of other stocks. But generally speaking, people tend to flock to a stock right before earnings because their hope is that it will, you know, take off like a rocket. So the implied volatility was that sort of chart that I told you guys about before, which is that assuming that the stock price goes nowhere, which is, this is a row actually, assuming that it goes nowhere, there's the cumulative sort of percentage that it will not get to this price or will not get to this price. And again, you know, if I was selling an option, I'm essentially betting with an 85% likelihood that it won't move to that price, and John Doe or Christian is betting that the small 15% chance that it will. So how this is correlated to a stock at earnings is important. See, Tesla, TSLA, was probably the hottest stock this year. And I won't necessarily talk about price, but I'm going to talk about here. And this is a This is a view inside of the Thinkorswim platform that I use, where you can see here at each earnings report, which this was October 24th, which was the third quarter 2018, you can see the red line drops, and that dashed line right there is on the earnings report. Does everyone see that? I'm going to hope that you guys say yes. Anyway, you guys may all be muted, I guess. Yeah, you're all muted. Anyway, so continuing forward, again, in January 30th, which is the fourth quarter report, it dropped, and that is the implied volatility. Now, that doesn't necessarily mean that price drops, but each time you can see that the implied volatility has some level of drop. It might be lower and drops further, or it might be super high and drops down. But the point being that implied volatility, which is a driver in options contract price, drops at earnings. So that's important. And I'm going to show you Google, which is a different stock, higher priced, has the same exact behavior, which is implied volatility drops. And therefore, if you were to buy the contract the day before and sell it, or excuse me, if you're to buy it the day before and sell it the day after earnings, you wouldn't get much of a return because it was worth a lot less. Does that make sense to everyone?
Yes. So
Okay.
it's like discounting, the immediate discounting.
Right, exactly. So for people who are selling it and they know that this drops, they're essentially laughing all the way to the bank because they know, as long as it does not make that 15% likelihood move, I win because I get to keep that profit because John Doe, made that sort of wild bet and he wasn't likely to earn from it. So I'm going to switch over here and show you guys how this works. So and apologies that this isn't sort of the plain Jane version of Thinkorswim. I'm actually going to do that quick here. Reset the workspace so that it doesn't look so scary. Yeah, sorry. So this is what Thinkorswim would look like if you were to open it on your computer. So we go over here and sorry, I'm not exactly sure how to anyway, yeah, so I'm having a little bit of trouble seeing part of these menus, so I'm actually going to drop this down. Right, so I'm going to go through two different earnings scenarios just to kind of prove my point here. And in order to do this, there's this on-demand button here, which the on-demand allows you to go back in time and sort of play out something like a scenario. So in the case of Tesla, Tesla actually had its last earnings report on July 22nd. So I'm going to go pick that calendar. That's weird. Yeah, there it was, July 22nd. And traditionally, the big stocks, like the high value stocks, are an after hours sort of earnings report, meaning that it's like 4 p.m. or 4:15 p.m. and the market closes at 4. So in that case, you have you have the day to sort of get prepared for this. So I'm going to hit go. And here we are. See, it's 9:30 in the morning on July 22nd. So I'm going to go over to trade or to charts and go to Tesla. And you can see here that $1,600 and sorry, this is a daily time frame. I'm going to switch to a 5-minute time frame. And yeah, so right here, July 22nd, 9:30 in the morning, the stock price is around $1,600. Now, Tesla went through a stock split in late August. Anyway, so the price is drastically different than, you know, than what it is now. But anyway, I figure out why this is. See, so some of this is actually showing a price, I believe, is adjusted as post-split. Apologies. Yeah, so just so you know, the price did not go from 300 to 1,600. That's a little bit strange. Anyway, so we know that the earnings report is today, in sort of fictional time, that is. And so if you look at the options contracts for Tesla, now one thing that does not show up here on the right is the implied volatility. I'm just gonna, I guess I'm gonna have to switch back over to the other tab to be able to show you that. And sorry, that's not the on demand. That's well, I'll show you it afterwards. But anyway, so it's $1,618, and I'm actually gonna fast forward to like 3:30 p.m. or maybe 3:50 p.m. And as you can see here, might be expecting military time. Yeah. So 1540, right there. So it's, the price had dropped a little bit throughout the day. And the contract that is expiring in 2 days is the one that you want to work with. And so basically, I'm just going to show you here that, you know, these are option contracts, which, as I mentioned, these expire 1 week at a time. This is 2 days from now. The next one's 9 days from now. The 22nd, I believe, is a Wednesday. Point being that at 16:01, you know, in a couple minutes or so, like at 1615, which is 4:15 p.m., they're going to announce their earnings. But what I'm going to do is I'm going to sell options that are way out of the money, and this delta or probability out of the money is going to be greater than 85% right here. See probability OTM, which is probability out of the money, which is all the way down here at $1,300, meaning that the stock would have to move $300 in one direction or the other in order for this to become a concern for me. So I'm going to click Control, and I right-clicked on this guy and say sell single. Excuse me, no, sorry, I meant to say sell vertical, which is a credit spread. And on the other side, which this is delta 10, by the way, correlates to that 85%. And on the other side, see, the probability is slightly different here. The 85% is actually at delta 19. I'm going to stick with delta 10. And again, I'm holding control, sell vertical. It's strange. It should be called an iron condor. And I'm going to right click and say analyze trade. This is very different than what I was expecting it to look like. All right, let me go back here. So the point is we have to make this happen by 4 p.m. on the sort of fictional time here. Sorry, I'm going to try this again. So again, you know, 1596, it hasn't moved much. We're selling a vertical on one side, and we're selling vertical on the other side. Yeah, that says iron condor. So we will get $3.47 or $347 profit out of that. And sorry, the scale is way off on this guy. Right, so the stock is this brown dashed line right here. No, actually, it's closer to 1600 right here. But the point is that this is profitable to the $300, $350 here, all the way from this 1600 mark down to the 1300 mark, and all the way up to the, sorry, this thing's goofy, all the way up to the 2000 mark, which is good. So, and I'm just going to sell one contract of that because, you know, this already actually will cost or will draw down by around $5,000 for 350. I know that's not exactly a good risk reward, but just trust me, the probability is in our favor that this will work 85% of the time. So I went ahead and sent that, and now you can see here it's working. The price is 325. We have 350 on it. So in that case, we're going to adjust the price. Oh, it actually filled. So anyway, so now we have, and as you can see here, it's already profited $25. And what I'm going to go ahead and do is I'm going to fast forward to 16. Let's see here. I'm actually going to fast forward to the next morning, 9:35 a.m. Go. So I think we're still waiting. Yeah, see over here, it says pre-buffering. So when it's pre-buffering, that means we're waiting for the price data and everything to update. Because again, we're playing back history, so it's actually a lot of time for it to sort of calculate. Does this make sense though? That we sold, you know, we sold the hype, so to speak, that this price was going to move $300 in one direction or the other. And most people paid a lot of money, assuming that it would. Now, I happen to know for a fact that it did not move that much. And when you scale up and you're doing more than one contract, you can actually walk away with a whole bunch of profit off of this because it didn't move that much. Wow. I don't know why it's taking so long to pre-buffer. Right, so there. As you can see, the profit and loss is $314. And that is because the stock price did not move that much. See, it's at 1646. So it moved $46 up from 4 p.m. the day of earnings to 9 a.m. the next morning.
And because everyone was, you know, sweared that they thought it was going to move big one direction or the other, they were paying lots of money for the calls and puts that we sold. Does that make sense to everyone? I'm going to go back to that graph just to reinforce what I was talking about a little bit here. This graph right here. So, you know, that was Tesla at $1,600, and we had sold puts that said it was going to be 1,300 and calls that said it was going to be 2,000 or somewhere between 1,900 and 2,000. And everyone paid roughly $150 of profit on this side and roughly $150 of profit on this side in options premium to us, betting that it would go this direction that far or this direction that far, and it did neither. It was 1646 after the earnings report. So we kept that money and we kept that money. Does that make sense? Anyone? Apparently I can't unmute all. All right, well, anyway, so that $377 is profit that we kept. And now it's not necessarily ours yet until the option expires on Friday. But what we can do is we can turn around and we can buy it back as an iron condor. And you can see right now, instead of it being a debit, it's a credit, meaning it's so worthless that they, in the theoretical world, they would have to pay us to have us buy it back rather than us paying something for it. So I just bought it back for $1. And so that profit is booked because these quantities are all zero. So anyway, that's strategy number one. Basically is that you're selling it high, which was, in this case, Tesla. They thought it was going to go down to 1,300. So we sold them puts at 1,300. And some of the other people thought it was going to go all the way up to 2,000. So we sold them calls. Sorry, I'm struggling to write here. And in the end, the cumulative profit that we kept between the difference of those was a total of $377 because it only went to 1646. So, you know, their premium that they paid on this side and this side was, I'll call it $180 or $185 profit off of each side. And that was off of one contract to each side. Now I'm going to do another example just to reinforce this for you guys. So the Google earnings or Amazon earnings actually happened a week later. So earnings season happens 4 times a year, and you can kind of go around and essentially scoop up the earnings plays. Yeah, there it is, 9:30 a.m. On that day. It's pre-buffering. So we're going to go and we're going to look at Amazon. So Amazon, sorry, I'm in a little trouble here. Amazon is a more expensive stock than Tesla. It's 3,000 something. And, you know, today is earnings. And so, again, you have option chains that are expiring, in this case, 1 day from now. And, you know, like I said, it's $3,020 or so. And at the end of the day is when it's going to report its earnings. So I'm going to fast forward to 15:45. And the reason why I go to, that's strange, I don't know why I did that. Yeah, so now it's all the way up to 30.75. So it increased a little bit. But the reason why you want to wait until close to the end of the day, if it's an aftermarket report, is that that stock price could move. See, it moved from 30.15 or 30.12 all the way up to 30.72 during the span of the day. So again, you know, I'm selling something that has an 85% chance that it will not get to that point. Now, as you can see here, we see all strike prices, and many of these are 100% out of the money. And they don't even have a bid or an ask price. Well, it's because it was calculated. Anyway, so I'm going to get closer to in the money, which is where this shade here and here intersect. And so, you know, at the delta 15 is 83%. I typically like to go at least 85, sometimes even all the way out to delta 10, which is 88%. And again, I'm holding control. I'm going to sell a vertical on one side, and I'm going to, on the other side, sell a vertical as well, which is an iron condor. And that shape should look familiar to you. That, you know, right where it's at right now, which is 30.60, 30.70, is you're going to have the profit of $1.40 or $140. And that is compared to a risk of $860. So that's actually a much better profit to risk ratio. So in that case, I'm actually going to increase to, say, 5 contracts. And you can see here that we're going to gain $700 at a risk of $4,300, which is still, you know, a 6-to-1 risk to reward ratio, but we're looking at close to 90% likelihood of that being a winning trade. So I'm going to click send, and we'll go over here to monitor. Now remember, this worked last week, and see this mark went all the way down from 140 down to 115. See, it's kind of fluctuating. So basically, I tend to adjust these prices ever so slightly to kind of sweeten the deal, make sure that it happens. So our Amazon just sold. It's already $12.50 profitable. So I'm going to fast forward to the next morning and say go. Sorry. So it's pre-buffering again. And there we are. So maybe Amazon didn't work out as well as we expected here. 32.29. 33.28. Okay. Yeah. Yeah, it's fluctuating a lot. See, it's $2,200 profit because we're still roughly $100 from where our calls are and $400 from where our puts are. So it worked. We had $2,400 profit, and I'm going to go ahead and sell those back, or buy those back, I should say. And as you can see here, it's a credit, which is actually a good thing, but you can't actually buy something back by receiving money. You have to have a cost for it. So I'm going to buy it back for a debit of 0.01, which times 5 contracts is $5. So bought it back. So there, weird. Claims only $570 profit. That's, I don't think I believe that. Anyway, it was still profitable. It should have been $2,000 profitable, but or whatever that is said. But anyway, so 2 profitable trades on earnings plays because that you know, it wasn't going to move as far as other people were betting, and we won. Does that make sense? You guys can type in the chat window if you want. All right, so we're going to move on to the third income strategy here, which is directional. This has a little bit less complexity to it, actually, than the earnings and the sort of option premium that we had talked about in the last strategy. Anybody remember this graph here? Where I talked about some guy took $27 million and turned it into $2.6 billion, considered the single best trade ever. And some other people, you know, took their buying low and they turn around and sold high, which this kept on going, by the way. This was as of July 8th. So I'm going to actually use the same Thinkorswim tool to go to those moments in time. And so these may disappear because we're going back to an earlier point to show these. So February 19th. And I'm actually going to do so 15:30 or 3:30 p.m. February 18th. I'm just going to give you a snapshot of what the market looks like for TQQQ. So TQQQ was $114.96 on, you know, nearing 4 p.m. on the 18th. I'm just going to write that down here. And I'm going to also pull up on a quick chart here, VIX. The VIX is the volatility index, and it's always good to keep an eye where the VIX is at. It was at 14 at that time, which is quite low, actually. So let's fast forward to the 19th, and we're going to go, say, 9:30. Open. On the 19th. Okay, so pre-buffering still. It's at $116. VIX is still at 14. And I could have my dates a little bit wrong on this. But anyway, so everything seems normal, right? And we'll look at the charts here. Apologies, I have some lines drawn here. And so volume is up. It's the sort of beginning of the trading day. And I'm just going to fast forward to a little bit and we'll see. So it could have been off by a day or two. Okay, yeah, I must have been off. All right, so we'll go to February 20th, the same time. No, must have been the 21st. All right, so there it happened. So now, yeah, it's pre-buffering. You'll notice that the VIX is up to 17, and you'll also notice that TQQQ is down to 110. So we had a 7-point drop one day, and it's already down 4 points the next day. So let's say that you were keeping an eye on this on your phone or something, and you're like, oh man, something is up, because, you know, it kept going here. These red lines won't be there. Apologies. Those are my sort of annotations from one point. But so something has gone wrong. And so as a trader, you're like, what if this keeps going? Why don't I maybe take one put and I'm going to go, let's say, 2 months out just to be safe. Okay. And let's say that I don't have a big account. So I'm going to go out here to a $90 range and I'm going to buy one put at $500, $600 or so, $695. Let's say that I'm going to buy two. All right. Just in case it goes all the way down there. So, so right here, TQQQ, June 20th, $90 puts. And the reason why I bought a couple months out was because, like, well, what if this drop continues? Does everybody understand what I'm talking about? That you can see that the stock market started to drop right here and right there. Is everybody able to unmute?
Yeah, I got it. I see it.
Okay. Thanks for answering, Bob. I felt like I was talking in an empty room here.
No.
So now this sort of drop is 2 days in a row is not necessarily normal, and you're like, that's strange. So what I'm going to do is I'm going to fast forward to the end of the day just to see how this is looking, and pre-buffering here. All right, so it's already up $250. Okay, so you're like, and so this is what you would call directional plays. Like, okay, I think it's going to go down, so I'm going to bet on it going down. So it's different from the whole betting on something not moving as far. It's sort of betting that you are moving as far. So I'm playing the John Doe role or the Christian role here, where I bought an option, betting it was going to go in a certain direction, rather than selling an option, betting that it won't make it that far. So someone sold me for, you know, $600 per contract that it wouldn't move And right now, those contracts are worth, let's see here, they're worth $700 something. So I've gained roughly $124 or $122 per contract. So because I have not seen any change in how this is going, meaning it keeps dropping, I'm like, maybe I was right. Maybe I should go a little more. And this is the concept of scaling into a position, meaning that you don't like push all your chips in thinking, oh, I'm betting it's going to do this. You can kind of observe and say, oh, wow, I was right. This is moving in the direction I was expecting. This was only $3 move over the course of the day, and it gained $120 per contract. So I'm going to go and buy something that's a little closer into the money. Not a vertical, sorry, I didn't mean to do that. I'm going to buy a single, and I typically buy twos of things, meaning that you can sell one back once you've sort of gotten your return on investment, and you can keep one. So these are $2,000, or they're $1,000 each, but the problem is that these are expiring, let's see, June, yeah. So we'll click confirm. So let's say that, you know, in total on the on this trade, and I'm just adding some columns here so that you guys can see what the percent change was and what the net liquidating value is for the trade. So I have a total of $3,500 invested in $3,600, and that's what the value is, including sort of the $9 profit and the $269 profit. So that $3,600 mark, you know, keep in mind of that. And if we look at history here, and I'm just going to back out to the daily here. Sorry, this scale tends to get out of whack here vertically. So this is Feb 20, I think. Yeah, we're Feb 21. So it's already seen this drop here. It's at like 107, right, when I'm buying this. So let's go all the way to Feb 27, which is a week later. Typically, you would keep a much closer eye on that than this, but I'm just kind of doing this for the sake of showing you guys what's going on here. 09, 3, so Feb 26th, pre-buffering here. So just try to ignore the Amazon and the Tesla. Those were trades that we already took. So take a look here. So the net liquidity of those those contracts is now $6,000 rather than $3,600. And you know, the profit for the 90 put is those two is $1,300, and the profit for the 100 put is $1,400. So now I know I told Christian that I was going to buy some shares to compare how shares versus options, how the value increase is different. But in puts, I decided just to do this as a directional options play only. The reason being is that I would have had to sell shares at the exact same time to tell you guys, to show you the difference. I guess I could go back. So we were on the 21st before at, say, 10. All right, I know I'm flipping around here. So pre-buffering again. these TQQQ values will be different probably. Yeah, see, it has not dropped yet. So, so even though we have these two positions, TQQQ is at $110. So it hasn't done as much dropping yet. And so the difference with trading options versus trading stocks is you have to do it in a different module. So I'm going to go over here to active trading, and I'm going to type in TQQQ. See, it's done some of its dropping already here, and it's like, oh, okay, so something weird is going on here. So instead of selling, I'm just going to sell like 10 shares, let's say, instead of, well, actually, I'm going to sell 1 share just to make my point. So I'm going to sell it at market price. So cost of trade is negative $110 because that's what it's worth. So yeah, so I'm selling market cent, right? So it's weird. I wonder why my share doesn't show up. Yeah, -1 here. Trade price is $110. So my profit is a penny. Okay, so let's fast forward to the 26th. Go 10 a.m. It's going to pre-buffer here. Okay, so I've made $19 off of the 1 share that I sold, and I know that I'm not using equal scale, so to speak. I've made, you know, $5,700 off of the options contracts. So let's say that I went back to Feb 21, 10 o'clock, and let's say that I sold 100 shares, just to be slightly more fair in my time or in my comparison. So I'm going to go back here and I'm going to sell. Let's see, so it's at 109. So I'm going to sell 99 more. So negative 100 shares at 110 or so. On this date, you know, I've lost, I'm earning $3 or $4, whatever. Anyway, so again, we're going to move forward to the 26th and we'll compare here. Yeah, 10 o'clock. Right. So the profit off of the 100 shares that I sold is $1,900. The profit off of the 2 puts that I bought at $100 and the 2 puts that I bought at $90 is actually, it's not as much per. It's like $1,300 and $1,200. But as you can see here, you know, so they're both profitable to the same sort of scale. However, if you got rid of those, or if you kept those TQQ shares, let's say all the way to the point where it reversed and went back up, you could owe more down the road once those shares increase in value, versus if the option, 1, it will expire over time, and 2, the option value, like what you pay for the contract is the maximum you'll lose. So, so we'll just fast forward here until, yeah, so Feb 26 was essentially the first uptick that happened in this crash. So if we look at the charts, and this is what, 15-minute chart. We're going to look at the 1 hour chart here, right? So we should set some dates over here. Anyway, so we sold somewhere around the 110 mark, right? And we sold the shares and we also bought the puts. And here we are down at the 90 mark. So, you know, we made a decent profit off of this. And the point is that you can't necessarily assume that it's going to always be profitable. So what you need to do is you need to essentially have an exit strategy that will make sure that you can close these trades without losing your profit. Does that make sense to everyone? You need to have an exit strategy. Anyone? Viewer? I'm going to ask you guys to unmute. Anyway, it should make sense. You want to have a primary exit and maybe a secondary exit. So, yeah, Hassan says yes also. Right, so, you know, this isn't going to fall forever. And as we know here in history, it did not fall forever. It actually went up on the 28th. It kept going down on the 27th. So there's a thing called a trailing stop, which is like a ratchet. And as you know, as it goes up, it follows you up the hill, or as it goes down, it follows you down the hill. So, you know, I'm pretty happy with this profit here. I don't know exactly, the net liquidity is negative when you sell shares, but you do get a profit off of that. So what I'm going to do is I'm going to create a closing order here. And I'm only going to do one of those two shares, or one of those two contracts, just to give you an idea. It's weird. Trailing stop is not available in this setup. Okay, well, it's a little bit harder to demonstrate something that's not available in a module. Okay, well, apologies. A trailing stop is normally available in Thinkorswim. For some reason, it is not available when we're doing the virtual account and doing sort of a, what you want to call it, you know, simulation. So with that, then a person, if you're sort of reviewing things backwards in time, you'd have to watch closer. But I can tell you, when you have live trading with real money, you can in fact use a trailing stop. And I guess what I'll do is I'll show to you sort of what a trailing stop means in terms of on here. So this chart that I showed you has the MACD, and as you can see here on the daily chart, see, this has not crossed over, meaning that, you know, even if it goes up here, it did not tell us to sell it. You know, if it crossed red over blue, like here, it would be telling us get out. But it did not tell us during this time. But there's a thing called ATR, average true range, which, sorry, ATR trailing stop loss. That's what I want. So it exists both in Thinkorswim and here. And you see this green line and this red line here. What that is, it's essentially an offset based on average true range. Average true range is essentially a probability of how much the stock could move one way or another, based on probability. So right here, while it's dropping, the average true range, and you see because of this gap, the average true range is actually quite a ways from the stock. So if we had, stock price at, or the symbol price at, say, $90, like we're showing here, which is roughly right around there, the ATR trailing stop was at $110. So it's fairly far distant to make sure that it would not kick you out of the trade in an unprofitable sort of part of the trade. So apologies that I cannot set these with a trailing stop, but what you can do is you can set it with a stop, and you can set it good to cancel. Good to cancel means it'll stay on until you tell it to not, or to stop. And see right here, the value of the contract is 17, let's call it 1735, which is $1,700 or $1,735 for the contract, which that's reflected in the fact that the net liquidity of the two is $3,500, right? So with that, now that doesn't exactly correlate to this average true range, but if it's at $90 and it's 110, so that's $20 higher than the total stock price. So let's say 20, no. Or I'm doing this backwards. So 22% of an offset, and we'll take that times 17, say 35. So that's 385. So 385 below 1735. Not times, minus. So I'm basically manually doing a stop at 1350, meaning that the option value could drop to 1350, and it would still not kick us out. So, and I'm gonna only do this for one of the two. So basically this thing could lose $4 or 400 something dollars worth of value and it still wouldn't kick it out. Now I know that's not ideal, but I want to illustrate after we go all the way up to this incline here on March 4th, that it should stay in the trade. So we're going to switch to March 4. Man. Apologies that I'm not able to demonstrate to you the, it's pre-buffering here. So keep an eye on this mark, 13. Yeah, so the value of our 100 shares sold is now worth 2,700 profit, and the 90 put and the 110 put is $2,100 and $2,400 profit total so far. And these are to June 19th. Now keep in mind that it's been roughly 15 days, so there is some time decay happening with these options. But anyway, as you can see, the mark actually increased because, you know, it was the overall stock price was decreasing, the symbol price of TQQQ. I'm just going to look and see here. See, it's at $83, but it went all the way down to 67. So, and that was on what day? Friday. So what is that? Sorry, trying to do some backwards calendaring here first. So it was roughly the 28th. So I'm going to go to Friday, February 28th here. And we can see what it was worth right there. That's 67. And it's pre-buffering. So look at this. See, 33. So these, during this sort of drop and hiccup and then drop again, right before the hiccup, or we call that a bear flag, these were each worth $4,000 profit and $4,200. So does that make sense to everyone overall, that because it's dropping and we have puts on, we're actually gaining income off of this? Does that make sense? It's the sell high, buy low concept, but we're using options. And you can see here this stop that's on, it's set up here. So anyway, so I'm going to go ahead and fast forward to the end of this drop, which is March, call it March 18th, actually. Thought it was more like the 23rd. Yeah, so we're going to fast forward to March 18th, and we're going to see what this looks like in terms of profit. Okay, so here we are. The shares that we sold maxed out at $7,000 profit, right? And the two puts that we have are worth 8,000, almost 9,000. Well, this one's worth 8,900 and this one's worth 9,900. So as you can see here, the one that's deeper in the money, the 100 put is worth more than the 90 put. But anyway, so this mark is 60, and so our stop never triggered. So I'll hit cancel order. So anyway, you guys can see here how we took a little less than $3,600 worth of puts, and over the course of this drop, it turned into $18,000, right? Does that make sense to everyone? All right, well, feel free to answer in the chat. Anyway, so, you know, and as you can see here, this was a low of 35. And again, because I can't set a trailing stop in the on-demand portion here, it's hard to know where this bottom is going to be. So I'm probably going to set some new stops for it. Just say that, okay, I'm pretty sure this is going to end sometime soon, you know, and using this average true range here, which is at March 18th, we're looking at 60 versus 37. And see, this is much farther out because the volatility, because of how fast it was dropping. Basically, it was claiming that these should be set at half of their value. I don't really agree with that. 20% is a good kind of sort of, I'm gonna call it conservative number. and 10% stop is a good sort of, I'm going to call it, and see, it's actually 40. So now today, this is increasing today, see? So we're like, oh, wait a minute. So our 18,000 profit on this is actually reducing in value. You can see what was, anyway, so long story short is you can always set 2 different stops for your position. So I'm going to do one if it's at 60. Let's say I'm going to do one at 10% back and one at 20% back. So 10% back from 60 is 54, and I'll say good to cancel. We'll call it stop. So we'll call it at 54. And then the other one, which this was the 100 put. So I'm setting manual stops on this, and good to cancel, stop. And so that was at 10%. The other one was going to be at 20%. So 20% down from 60 is roughly 12. So that's 48. And I'm going to do the exact same for these. So if it's at 50.7, 10% down is 5 less. So we'll call it, now see, you've got a big spread here. So we're basically setting it off of the ask. So 55, go to cancel. Oops. Something just sold. I don't think I meant to do that, but anyway. So yeah, we've got the 2 working orders for the 100 put. So one is at 48 and one is at 54. So March 18th was the bottom. So let's say that move to yeah, it's gonna be slow. All right, so I'm gonna move to March 25th and hit go. Pre-buffering here. Now these may not trigger because of the whole sort of fast forwarding function we're doing. They'll likely trigger, and so remember that, yeah, see, so our total profit for the 90 puts was 8,900. The 100 puts is around, yeah, see, this has gotten closer now, see, 54, 58. So we know that these 2 are losing value. So you could say, okay, instead of letting the stops trigger, I'm just going to close these out because I know that they're losing value, right? So I'm just going to cancel and replace and say, I'm just going to do a limit order. And when I sell it, I want to sell it for the most money rather than the least, which is $5,800 or $5,600. And this one also is worth 58 rather than, you know, whatever it was worth before. So with that, the total profit from TQQQ for these 2 sets of puts was, you know, close to 18,000. The shares which we sold are now worth less because, as you can see here, we've already started the rebound. The low is 31. Now it's at 41. So, so now what I'm going to say is, okay, I think it's going back up. So then instead of buying puts, I'm going to buy calls. And I don't know when it's going to stop going up. So maybe January is a good time, you know, because it's a ways out. I don't know. Let's say it's $100 that I think it's going to get to. See here, it's 79 cents or maybe $70. So I'm going to buy 2 at 70, and those are $345 each, $690. And so I'm going to move forward a couple months, and you can see exactly how, if we left our shares that were sold, if we left them be where they are, let's say that July 13th. So let's say that we move to July 13th. Well, actually, sorry, we're on March 25th. So let's say that 2 days from now, we hit go, and we can see that our calls have gained some money with the pre-buffer finish here. All right, so our calls have gone up. And as you can see, our shares are still worth 6,000 or so. So if the calls go up, that tells you, you know, we're gaining traction here in a bullish direction. So it's $45, right? So I'm like, you know, maybe I'm going to pick up some 60 calls. And, you know, again, these are January 21 because I want to make sure that they, you know, that they don't expire anytime soon. So I have 60 calls, 70 calls, and the net lick that I spent on them was a lot more, obviously, because it's closer to being in the money. So let's say that we move forward a week, and we'll see where we're at. Now, because the drop happened so quickly, those puts increased the value rapidly. The calls will not likely increase as quickly. You can see here that the 70 calls are worth, or they have $105 profit. The puts, or the 60 calls have $71 or loss. I don't know why that is. Oh, because see, it was 45 the other day when we bought them. Now it's 43. Anyway, so let's just move a couple months, let's say. So July, yeah, I think we're saying July 14th. That's weird. Oh yes, there was a drop on this day. Okay, that's 18th. Right, so here's at the peak. So the calls that we had are now a profit of 12,000 and 11,000 respectively. And take a look at the shares that we sold at 110. They're now worth a negative 1,300 because the shares are now, share price is now 123. So it's worth more than we sold it for now. So to buy them back, we would have to pay money rather than have a profit on it. Does that make sense? But the calls, which are directionally positive on an increase in stock price, are worth, you know, the roughly 25,000 here. So, you know, again, the whole you can't do trailing stops on this, but let's say that I'm quite happy with how things are. And see, notice that the VIX is up at 27. Because of this whole drop, the VIX went all the way to 86. The VIX is the volatility or the fear index. And so lots of people are still roughly twice as scared as what they were in February. And when the VIX is low, it usually means people are happy as a lark when it comes to how the market's performing, which it was at all-time highs in February. So, you know, let's say that I'm happy with this, and I'm going to go ahead and close out one of these two. And don't forget that you can adjust this scale to sell it on the higher side. And same goes for this guy. Selling one of them on the higher side. So, you know, there was this brief drop here that happened where on July 13th, 14th, but then later, and there's another drop, this sell by, another drop in September. Let's see, so I'm gonna go to September 1, just to illustrate how much the other, the remaining, I guess, contract is worth. So, you know, the remaining open $6,200 per contract. So September 1, we'll hit go. Are we seeing that right? Yeah. So that contract is worth 10. This contract is worth 9,000. And as you can see here, these shares are now worth negative $5,000. So I'll just sell these. Let's sell them all the way down at, let's say that I think a drop is coming. And so I basically set a sell order that I think that those shares are going to sell at 120. They're at 168 right now. So they won't sell until they hit 120, drop to 120. So right here, like I said, it's worth $10,000 and $9,000. And on September 1st was the last sort of all-time high right here. September, I guess, 2nd. It's around 170 something. So, you know, again, if you had a trailing stop, which I would recommend, is setting at roughly between 10% or 20%. But as you can see here, you know, with small investments of like 1,000 or so, you can turn it into 10,000 with a call or a put. Of course, the selling of the shares was also profitable, but the amount of capital that you have occupied in selling those shares is actually probably close to 100 times as much. So that's one thing I didn't explain to Christian, is that when you sell shares, it will debit from your account as a temporary hold the amount of money to cover the price of the shares. So, if you sold 100 shares at $110, 100 times 100 is 10,000 something dollars would have been deducted from your account, assuming you had that much. So anyway, I'm going to go to and see. Keep in mind 9,900, 10,003. Let's move to September 3rd, and we'll hit go, and we'll see what these prices look like. Keep in mind the VIX up here as well. So now it's worth 9,700, 9,300. So something dropped, and the VIX is at 27. If you go look at the chart, the TQQQ went from 176 down to 159. And this is one of those, oh man, sort of bad red days. So at this point, it's like, man, I better get out of these, you know. Now, of course, your trailing stop would get out for you if you had the option to set that, which, like I said, this simulation doesn't allow it, but a normal account would have that. And a trailing stop is a good way to make sure that you can exit a trade profitably. And again, I have a working order at $120 for these stocks, which would still be a loss, but it would be a much smaller loss than what you currently have. So moving to Tuesday, or I just want to show you guys, you know, in this last week was when we had this other drop here. But as you can see here, you know, don't be mistaken. The profit off of these TQQQ trades is $48,000 so far. Hopefully that makes some of you kind of surprised in a good way, considering that we had maybe $6,000 invested. All right. So yeah, your shares are now only a loss of 2,000 because the stock price is 132 now. Now I happen to know that it bottomed out at like 117. I want to say at the end of the day, maybe this day. $125. So the shares are getting closer to being break even. And of course, you can also set a trailing stop on share sales as well. Like, so if you short sold these stock prices or these stocks at 110 and bought them back, you can set a trailing stop as to when those are bought back as well. I'm gonna fast forward to 1800 that same day. See, it's at 119. So if you can see here, it's close to profitable. Well, less of a loss, let's say. So I'm not sure if this working order is going to trigger. That's weird. It's set to 120. Mark price is 119. Those should have sold. It's one of those things where a working order like that doesn't always trigger when you're moving your time around, you know. Yeah, see, it's at 120 right now, 120.44. because the goal is to buy back these stocks at anyway, I don't know why these aren't triggering, but the other way to do it, instead of doing a limit, is you can just switch it to market, but you can't actually buy market after hours, I don't think. So anyway, I don't know why that's not selling, but the point is to try and buy it to buy it back as cheap as possible. But does everyone understand the concept of when we bought the puts when it was dropping and when we bought the calls when it started to rise? For those of you who are left. Does this make sense? Hello? Oh, the microphone's not working. But does it make sense, Hassan? Okay, good. Anyway, so the point of this in this particular strategy was to buy directional in the trend, the way that the trend is going, and to you know, follow that trend as far as you can. So, you know, in the end, I'm not sure what our total investment was, but I want to say it was less than 7K, and the profit and loss, meaning the money on top of the 7K, was 49 grand. So it's pretty good. Anyway, so I'm gonna wrap this up really quick here, and you know, this resources page, which I'll make this slide deck available also. And you know, charting tools like TradingView, stock screeners where you can find things that are, say, dropping or rising, earnings reports like are listed on Estimize and Earnings Whispers. Sentiment, where people are talking about what direction a stock is going. Stock Twits is kind of like Twitter for stock traders, and places where you can get indicators, things that compare brokerages, but I recommend TD Ameritrade and Tastyworks. TD Ameritrade's got a paper trading option, which Tastyworks does not, and YouTube channels, which are very informative. Market Moves is another good one. This guy, Matt Giano. He's also very good. I need to add that.
This is Market Moves. Come.
I know. So he's. I think he.
Here's the honest truth, traders. You don't need anything special to make a profit in the.
Now he uses some of the time he uses Robinhood, which I know I've kind of sworn against it, but you know, apparently he finds it good enough. But I personally prefer TD Ameritrade mainly because of the paper function as well as their trading tools, much more robust. You don't have any kind of indicators with Robinhood. Plus, like I said, I'm not sure if you can totally trust. You know, there was that one guy who his account said negative $730,000 and committed suicide. That was a glitch, obviously. So anyway, just in conclusion, you know, this is a life skill. It's not like winning the lottery, so have realistic expectations. And understanding is more important than instant success. So the hope if you can understand, obviously we were looking back at this year, and says how much minimum does it make sense to trade in the market? I mean, you could trade much smaller options with even a $500 account. I would recommend starting with more than that if you can. But you know, if you do a smaller account, $500, what you want to do in that case is you want to stick to smaller or lower priced options, and which TQQQ is actually a good one in that regard, because if you look at the price of a option contract, see the price of stock right here, 120, and this is on September 8th, which is a couple of days ago. And let's say that you think it's going to go back up. I'm not necessarily saying, but let's say that you think it's going to reach 160. Keep in mind the all-time high was 176. Now this is a January 21. Now that's way down here. If you were to pick a 1 week from now option for the same price of I think I said 160. You can buy that for, sorry, I think I accidentally closed that. All right, so let's say it's the September 18th contract for 160. You can buy that for $83. So, you know, you could in theory have even a $100 trading account and you could trade one contract at a time. But, you know, as I mentioned, it's not good to say bet all of your account on one trade. It's recommended now with small accounts, you're going to have to do larger percentages of that account, but ideally your contracts and your positions are 1 to 2% of your account. So let's say that you had a $1,000 account. 1% of a $1,000 account would be $10, I guess. That's so, you know, when they say that, and that's the ideal formula. So they're probably looking at a $100,000 account and you're using $1,000 on a position. But like I said, when you have smaller accounts, you do have to wager larger portions of that account, which is why, you know, you want to probably do the majority of your trades based on high probability. And so if this 160 call, it says it's 94% out of the money likelihood. So yeah, you're looking at a 5% chance it'll make it there. And I'm actually going to, and as you get closer to in the money, which is this purplish area, see that probability of out of the money decreases, meaning you've got a 51% chance of it being out of the money at $115, let's say. But they also cost a lot more than you're looking at $1,100 contract. And keep in mind, it is expiring 10 days. So the farther out the expiration, the more it costs, but also has a higher likelihood that you'll make it there. So yeah, you know, if you're doing small accounts, it's probably best to do higher probability trades with the majority of your money, like the earnings trades or the trades that I showed last week, which was like the last seminar, which was the NDX trades, where we think it's going to be one direction and it doesn't make it that far, and you kept the premium off of it. Now, there is a whole bunch of YouTube people who dedicated themselves to small accounts. Like if you type options small account, you know, I've never actually used this guy. 3 ways to trade options with a small account. This guy, Project Option, is one of my recommended down here. Project Option, this guy, he goes through small account tips, strategy, etc. Matt, the same guy, Market Moves, how to grow a small account. This was 8 months ago. So, there's lots of people who go through the concept of small accounts. So I would definitely recommend you pay attention to those. One other guy, actually, Bill Poulos, he, I don't think, does much on YouTube, but he was recommending to work with stocks that cost $40 or less, and then the option prices for those are much cheaper. But you also have smaller profit as well. So I hope this was helpful for everyone. And I guess last but not least, you're not going to win every trade, but long term, the goal should be to win more than you lose. So do you guys have any other questions?
How much time do you think it would take for the average person to reach a level of like average proficiency with stocks and options, like years or?
I'll say that trading daily, I've probably been doing since March. But, I had exposure to this long ago. But to sort of get more confident with things, you're looking at a few months. But again, on my sort of recommendations is to kind of focus on one strategy and get very good at that one strategy. That way, it's not like you're trying to learn the entire language. You're just trying to learn like how to say hello, that type of thing. So I would say even in a month or a couple weeks, you can feel confident with that one strategy, assuming that it's gone okay. Now, I will say that this exact moment in the stock market is a little bit uncertain. So you may want to just work on getting your account set up right now. Like TD Ameritrade, they ask a few questions when you open an account. You don't even have to have any money in the account. So you could have it be zero and you could use their paper trading to test. But they ask a couple questions like experience, etc. And typically they grant your account privileges based on experience. So it's one of the few times where it's kind of like your resume where you want to sound really good. So, with that, and if you want to reach out to me privately about it, you want to say that you have options experience, even if you're learning, and you can spend time on the paper trading side to learn. So you can say oh yeah, I've got 3 to 5 years of experience, and in actuality, you're going to spend the next month figuring out those things. But that's just to get the account open. And like I said, you can open an account and have no value in it, and you can still paper trade on it. So I would say you can learn at least one good strategy in a month's time of testing things. And you can probably fast forward that even more by using what I showed you with the on-demand virtual, or if you sign in on the paper trading account. Either way, it allows you to, the on-demand side, which is that little button in the upper right corner, allows you to fast forward or go back in time. The other way to do it, if you're not using the on-demand function, is if you go over to the Think Back, which is under Analyze, Think Back. Here I think you can not specify a time, but you can specify a day. So, if you're looking at TQQQ again, and we're looking at September 11th, which is Friday, it's at $121. If you're looking at September 1 and you hit go, it was $169. And if you're looking at February, let's say 20th, previous all-time high, it was $114. So you can use, and you can see right here where you have option chains, and I'm not sure what that button does. You can see here below a chart. So you can look at like, where are we on the chart and what is the date? So you can use these tools to kind of accelerate your understanding. On the on-demand side, I'm not sure if the think back function exists. Looks like it does, yeah. So that you can paper trade. And you can see here, I drew these lines on TQQQ, which also exists. It's almost the same exact things for SPX, which SPX is the S&P 500. And basically, there's this thing we call it a resistance line, where the market hits a point and it starts to pull back very sharp. You see how that tip of that peak and tip of that peak and tip of that peak align? So that's what we would call, a resistance point that it did not succeed. So anytime that, and you might want, and again, technical analysis is another thing you can look up on YouTube, stock technical analysis. You can understand that there are certain resistance lines out there that every time it hits, it goes red for several days. In this case, gapped right here. So again, what I was saying is, you can learn a lot quickly using these day functions where you can go back and forward and you can simulate trades and how that would have turned out. And you can also begin to understand, like, oh, on these huge pullbacks, I want to be in a put. I definitely do not want to be in a call, or I want to be selling shares if you're doing this in those times. Otherwise, in these cases, you would be buying either calls or buying shares for profit. So yeah, I hope this is helpful to everybody. We went quite over what I was expecting from a time standpoint, but I hope it makes sense to everyone, and I hope that and you guys find it useful, and we will definitely send out a link to this on YouTube. I'm gonna have to do a lot of editing to shorten this down. And links in the YouTube will include the slide deck as well as some of the other resources. Any other questions?
So, do you know about any free courses on Udemy or the city where we can learn more, or
On which?
Like online learning platforms?
Udemy or?
Yeah, or any other that that, oh man, this is a really good course that I would recommend to learn more.
Specific courses, no. I want to say that lynda.com was offering free courses during this pandemic. I guess they have free months. Let me just sign into my LinkedIn platform and see that maybe, sorry, quick security check. What's this? Yeah, I have two-factor authentication now. That's a new thing. Wow, someone just joined. Oh, Hassan. Sorry, I'm trying to see where my whatever two-factor. Oh, it's email. Okay, that's why. Somebody's got interference going on there. So I was just checking to see if lynda.com was still free. What? Why do I have to have a new password? Okay. Well, anyway, I believe lynda.com was free. Udemy is not free. Udemy was one of the ones that I sort of learned how to do the Iron Condor like on NDX, and then wait a month and you can harvest that profit, similar to what you can do over the course of a day or an overnight with an earnings report. I think it's called Jeff Tompkins, something another. Let me just see if we can find it here. Jeff Tompkins. But there's still a lot of resources on YouTube that are really good. How to win with weak options. Anyway, Jeff Tompkins is pretty decent. I can't remember the exact course. But this one, yeah, he also does technical analysis. And you know, the idea was to sell options premium and then harvest it back with you know, with the time decay. So you know, a lot of these things are very similar. But like I said, there's a fair amount of at least the resources that I included on YouTube are all people who know a lot, and I've never had any bad advice from them. So I would start probably with the YouTube stuff first, and you know, with the small account sort of advice and trades, and work from there.
That makes sense. Thank you, Brandon.
Yeah. Apologies, everybody. I'm going to have to call it a session, and you know, we'll probably have more seminars on other things in terms of not necessarily trading, but other ways to make money with your newfound sort of extra time with the pandemic. So thanks, everybody, and we'll see you again next time.